Assalamu alaikum warahmatullahi wabarakatuh. Hello everyone. First let me introduce myself. My name is Debbie Noor Fajr ANPM 23411165 Class MNJ23C. Here I will present the business law course, entitled Aspects of Business Tax Activities. Taxes play a crucial role in business activities, as they are the financial contributions required by businesses to support government functions and public services. Businesses, both large and small, are subject to various tax obligations, and understanding these obligations is essential for ensuring legal compliance, optimizing financial planning, and avoiding potential penalties. Here are the key aspects of taxation in business activities. 1. Types of taxes in business. There are several types of taxes that businesses are typically required to pay, depending on the jurisdiction and the nature of the business. Common types of taxes in business activities include corporate income tax. This tax is levied on the profits made by a business entity. In many countries, the tax rate can vary based on the company's income level, type of business, and location. Corporate income tax is one of the primary sources of revenue for governments. Value-added tax, VAT, or sales tax. This is a consumption tax applied to goods and services sold by businesses. In VAT systems, businesses collect tax on behalf of the government and remit it based on the value added at each stage of the production or distribution process. Withholding tax. A tax that is deducted from payments made by businesses to individuals or other entities, such as salaries to employees or payments to contractors. The business then remits the tax directly to the government. Payroll tax. These taxes are paid by businesses to cover Social Security, unemployment insurance, and healthcare contributions for their employees. They are often calculated based on the wages or salaries of employees. Excise tax. This tax is applied to specific goods, such as tobacco, alcohol, and petroleum products. Businesses that manufacture or distribute such goods are responsible for paying excise tax. Property tax. Businesses that own property, such as buildings or land, are subject to property taxes. The tax amount is based on the assessed value of the property. Import-export taxes. For businesses involved in international trade, import duties or export taxes may apply to goods imported into or exported from a country. 2. Tax planning and optimization. Effective tax planning is a crucial aspect of managing a business's finances. It involves the strategic management of taxes to minimize tax liabilities and ensure compliance with tax laws. Key elements of tax planning include tax deductions and credits. Businesses can reduce their taxable income by claiming allowable deductions, such as expenses for operating costs, wages, interest, or depreciation. Tax credits, which directly reduce tax liability, are also available for certain activities, such as research and development or environmental investments. Choosing the right business structure. Different business structures, e.g., sole proprietorship, partnership, limited liability company, corporation, are subject to different tax treatments. Businesses may choose a structure that optimizes tax efficiency based on their size, revenue, and long-term goals. Transfer pricing. Multinational companies engaged in cross-border transactions must comply with transfer pricing regulations, which ensure that transactions between related companies are priced at market value for tax purposes. This helps prevent profit shifting to low-tax jurisdictions. Tax deferral strategies. Some businesses may use tax deferral strategies, such as deferring income or accelerating expenses, to reduce taxes in the short term. These strategies need to comply with tax regulations and must be planned carefully. International tax considerations. For businesses with international operations, understanding the tax rules of each country in which they operate is essential. International tax planning can involve issues like double taxation, tax treaties, and tax incentives for foreign investments. 3. Tax compliance and reporting. Tax compliance refers to the obligation of businesses to follow the relevant tax laws, report accurate financial information, and pay taxes on time. Non-compliance can result in fines, penalties, and legal action. Some key aspects of tax compliance include filing tax returns. Businesses must file tax returns with the appropriate government authorities, e.g., tax offices, revenue agencies, by specified deadlines. Tax returns typically include information about income, expenses, and the taxes owed. The frequency of filing, monthly, quarterly, annually, depends on the type of tax. Maintaining accurate records. Businesses businesses are required to keep accurate records of all financial transactions, including invoices, receipts, and payroll records, to substantiate their tax filings. These records are necessary for audits or tax inspections. Audit risk. Tax authorities may conduct audits to verify the accuracy of tax filings. Businesses should be prepared for audits by maintaining thorough documentation and ensuring that all deductions and credits are legitimate. 4. Impact of taxes on business decisions. Taxes can influence various business decisions, including pricing strategies, expansion plans, and investment decisions. Businesses must consider tax implications in their strategic planning, pricing, and cost structure. The application of VAT or sales tax can affect pricing strategies. Businesses need to factor in tax costs when determining how to price their products and services to remain competitive while ensuring profitability. Location decisions. Some businesses may choose to locate in regions or countries with favorable tax environments, such as low corporate tax rates or tax incentives for certain industries. These decisions can affect operational costs and long-term profitability. Investment decisions. Tax incentives, such as accelerated depreciation or credits for investment in certain assets, e.g., renewable energy projects, can influence a business's decision to invest in new equipment or expand operations. Dividends and profit distribution. Tax rates on dividends can influence decisions about whether to retain earnings in the business or distribute profits to shareholders. 5. Tax risks and liabilities. Failure to comply with tax laws can lead to substantial risks and liabilities, such as penalties and fines. If businesses fail to pay taxes on time or underreport